So Alibaba was on an absolute tear in 2023. Oh wait, this negative 20% graph is not the right one. This is the right graph. As long as you invert the chart, you can see that it basically goes 45 degrees to the right. Jokes aside, I do understand that it has been very trying and very tedious times to be holding onto Chinese equities in the last 2 to 3 years. Recently, there was this very interesting theory that was floating on X regarding why Alibaba's share price continued to stay submerged, and he even gave very compelling and very convincing stories behind how the different players in the financial business is purposely keeping Alibaba's share price down. And if I may quote, because no one, starting from SoftBank, has an interest in squeezing this fallen angel. The obvious benefit for SoftBank of Alibaba's price going down is even written black and white in their financial reports. So in this video, we will be investigating this claim, talk to you a little bit about how I think of this entire issue and what you can potentially take away from this. So as always, remember to help smash that cute little like button as well. I think it will be helpful for us to go back in time to look at the developments around SoftBank's shareholding in Alibaba. So SoftBank has moved to sell almost all of its remaining shareholding in Alibaba, limiting its exposure to China. So the Japanese group has sold out $7.2 billion worth of Alibaba shares this year through prepaid forward contracts after a record $29 billion sell down last year. So the forward sales, revealed through a Financial Times analysis, will eventually cut SoftBank's stake in the $262 billion Chinese e-commerce group to just 3.8%. And the Japanese investor once owned as much as 34% of Alibaba. So that's essentially a 90% trim down from 34% to 3.8%. Financial Times did assert that SoftBank's sell down comes at a pivotal moment for the Japanese group, which is planning a blockbuster listing of the UK chip designer ARM as it seeks to recover from a spate of failed investments and unprecedented losses. At the peak of Alibaba's valuation, they were valued close to $600 to $700 billion. That was worth over $200 billion. So I believe they actually 100x their investment. Now, if you were to observe the trend of SoftBank's dwindling Alibaba stake, you can see back in 2019-2020, as Alibaba's valuations continue to skyrocket, post-2021, the valuation has been coming down, I think on two fronts. First, it's of course because of the natural devaluation of the Alibaba stake as they continue to shrink. And second, it's because of this mid-tone blue, where you can see that a larger and larger portion of their Alibaba stake is the percentage of shares sold in forward contracts. So now, with that context in mind, let's look at what Daryl has to say. So in his very alarming tweet or X post here, he said that in a scramble to survive, SoftBank is killing Alibaba. So Baba closed the session crashing 9% after the results beating expectations across the board, leaving many dumbfounded. Of course, the media quickly make up a narrative to write a story that could more or less fit the price action. So Alibaba crashes after pulling its cloud unit listing due to US sanctions risks. So on August 10th, 2022, SoftBank announced the physical settlement of the prepaid forward contracts related to Alibaba's shares. At that time, SoftBank owned 23.7% of Alibaba. When all these derivative contracts expire, they'll be left with only 3.8% of Baba's shares. So what is a prepaid forward contract? So in this derivative, the buyer of the shares, which is the brokers in this case, pays in advance to the seller, SoftBank, the present value of the future sales price agreed upon. So, thanks to this trade, SoftBank immediately booked a gain for the quarter since they were marking to market their Baba holdings at around $91 at that time. Furthermore, banks paid them a badly needed $11 billion in cash. Can you imagine that the time the Japanese yen was trading at 135 against the US dollar? So the overall gain for SoftBank out of the whole masterpiece of financial engineering was nearly $34 billion at that time. So I know that some of you might look at this entire paragraph, you do know the individual English characters, but when put together into a sentence or into a paragraph, you might not really understand what exactly they're talking about. So I'll be using a separate example to basically flesh out to you what they mean by this entire financial shenanigans of a prepaid forward contract. So stay with me here. So if the price of Alibaba were to go up above the forward sales price, SoftBank would be on the hook with its brokers to post more collaterals and or return some of the cash they got in advance. At that time, SoftBank didn't close a single contract, but they agreed on multiple with many brokers on different maturities. By design, the longer the tenor of the forward contract, the bigger discount applied to the brokers, and the lower the BABA price above which SoftBank would be on the hook. I think it's simply put, because of the time value of money, if the maturity date is much out further, the discounting applied is much greater. That's why you get lesser cash upfront. But that's just simple discounting. Just know that $1 today is worth more than $1 tomorrow, or $1 1 year, 2 years, 3 years later, depending on the maturity of the contract, which will come into play when we talk about the prepaid forward contract later on. So imagine for a second if the stock's FOMO would have bit BABA like it happened to Magnificent 7. That would have been a disaster for SoftBank, right? Imagine if instead of trading at a 19 times PE, BABA would trade at 117 times PE like Nvidia does. So despite the economic struggle of China, Alibaba revenue growth still held up. So how come there is such a massive gap from the US peers? Because no one, starting from SoftBank, has an interest in squeezing this fallen angel. So the obvious benefit for SoftBank of Alibaba's price going down is even written black and white in their financial reports. The results highlight there's a $963 billion investment loss. So specifically for Alibaba, there's a $237 billion unrealized valuation loss on Alibaba, which was offset by a derivative gain of $642 billion related to the prepaid forward contract, which we talk about in this entire thread itself. And of course, like many controversial posts, Dario threw in something crazy. By the way, if you think Jack Ma is throwing in the towel and decided to sell 850 million of his shares at these depressed prices, then you might want to take a look at how much margin lending BABA founder and early investors got on their stock. Jack Ma just got margin called. Period. That's a big assertion. I think at the time when he was writing this post, Jack Ma's family office said that they wanted to sell, but have since backdated on that comment and they've decided to continue diamond handing. Given the high interest rate environment now, investors are probably comparing their options out there in the market, looking at which solution provides the best bang for the buck. So let me introduce you to something that I've personally been using. It's actually called Moneybu. So Moneybu is essentially a wealth management tool offered by Weibo, and without a lock-in period, Moneybu actually helps you earn a yield by investing your idle cash into the underlying cash funds. So based on the latest 7-day USD yield, they have actually delivered around a yield of 5.4% per annum. So on top of earning a yield on your idle cash, you can now actually participate in the Moneybu campaign. Fund minimally US $2,000, activate Moneybu, and maintain your funds throughout the event period. And you can get cash vouchers worth up to USD $3,000 if you actually hit and qualify for the highest tier. And this is the highest reward quantum Weibo has offered till date. So rather than getting your cash locked up in debt-based instruments or sitting idle in your brokerage account, you can now start earning yield on your cash while maintaining its liquidity. So the Moneybu's underlying cash funds are portfolios consisting of short-term and low-risk debt securities. But although it is low risk, it does not mean that it is risk-free, so don't mix them up. So I've personally participated in Moneybu's previous campaign, which required me to deposit minimally $5,000. And Weibo has since lowered their requirements to meet for the campaign. However, the mechanisms to activate is the same. So I'll play a short clip from the previous round where I demonstrated how to take part in the event. Go to the up to $3,000 cash voucher, which is the current promotion that we are talking about. Click into the banner and then tap participate now. You can see that this is essentially the mechanism of the campaign reward, which I've explained. So step 1, after you click participate now, and then you need to activate Moneybu in your Weibo app. And the second thing, of course, the second qualifying criteria is to accumulate the deposits and to not transfer your fresh funds out until the end of this year. Did I also mention that Weibo also provides an invitee-only campaign for new users? So new users who use my referral link to Weibo down below can now create, fund, and maintain any amount in their Weibo account for 30 days and win 10 fractional shares worth between $30 to $5,000. So on top of really attractive campaigns, Weibo actually offers a global community where it allows you to interact with other like-minded investors. So you can share your experience, your insights, and any tips about the market in this close-knitted community. Sometimes all you need is an opportunity to bounce ideas with other investors, and I believe Weibo's community platform is one of the best to help you with that. So to give you an example, let's say you are currently interested in a stock like Alphabet. So you can first search for the stock in the Weibo app, click onto feeds, and you can see a quick sentiment analysis on whether investors on the platform are bullish or bearish. Subsequently, you can scroll into the individual forums to understand what other investors are discussing about the company and make your own assessment from there on whether you wish to spend more time researching about the stock or not. So for those of you without a Weibo account today, I don't know what you are waiting for. Sign up with the link below now. Thank you Weibo for sponsoring this video. So I think let's just go back to the fundamentals of this entire discussion. It goes around, or it revolves around this financial derivative that we are talking about, which is a prepaid forward contract. So I think just a disclaimer, even though I'm a finance student, I didn't specifically study this contract. Everything that I'm going to explain in this video is just based on my own research and my own understanding. If I'm wrong, I stand corrected. And for those of you who have a better understanding of this, feel free to leave in the comment section down below as well. So based on this article, the PVFC is a strategy employed by investors who have large stocks and want to generate liquidity. Sounds about right, with SoftBank having around a 1/3 stake in one of a big conglomerate out there with $400 billion in market cap back then. So under a PVFC, investors agree to sell certain amount of shares at a discount, usually between 75 to 90% of the prevailing market value. But the buyer doesn't take ownership of the shares immediately, but at a future date, mostly after 2 to 5 years. However, the number of shares owed at maturity is a variable and not necessarily the earlier fixed amount. Here's the layman argument. Assuming that I'm the investor and I found a buyer, most of the time, many of these buyers are your big financial institutions, your brokers, your banks, whoever. Only they have the financial capability to take up this position. So some of you might ask, hey, why not SoftBank just sell it out in the open market? Due to the nature and the size of this entire transaction, there might not be enough counterparty to take over all of SoftBank's Alibaba shares. So if right now, let's say that they wish to offload 10% of their position, that's 10% of all Alibaba's outstanding shares. So usually, for this kind of transaction, they need to find a counterparty privately so that it doesn't create such a huge volume distortion or volatility. Secondly, it's of course due to the different tax implications and capital gains, etc. So let's go into the inner workings of a prepaid variable forward contract. So to understand a PVFC better, we can explain it by breaking it down to the individual words. Firstly, it's a contract usually between an investor and a financial institution or a brokerage firm. Secondly, it's a forward contract since the agreement stipulates that the shares will be delivered by the investor at a future date. So this then allows for the prepayment to not attract capital gain tax. This is because the transaction is not completed and the payment is actually treated like a loan or debt instrument, and the underlying security acts as a contingency. And last but not least, the prepaid forward contract is variable, since the number of shares to be delivered by the investor depends on the subsisting share value at the material time of expiration or maturity. So as you can see, it's basically a financial engineering at its finest. And don't ask me why they wish to engage in such a complicated transaction. There are definitely benefits that we don't see as normal retail investors. So it is what it is. So I think circling back to this entire idea around the conspiracy of how nobody wishes Alibaba share price to increase, I think I just wanted to put a caveat here. One of the largest institutional investors of Alibaba, owning at a peak 30% of Alibaba share, basically selling down 90% of its position. That's the kind of pressure that is being applied on Alibaba's valuation. Let's take an average of $300 billion in valuation. A 30% stake, that's $100 billion selling pressure. Regardless of what kind of company you are, $100 billion selling pressure, unless there's a big counterparty willing to take over all the position, I think it's pretty intuitive to look at the share price basically just continuously underperform major indexes. But that's it. I think I wanted to circle back to this entire theory and to share with you what's my thinking framework and how I look at this entire transaction itself. So a very simple mental model that I'm using here is really understanding what's the incentive structure like. So for instance, an investor's own shares shares in Company A, whose shares are trading at $5 per share, and the investor pledges 100,000 shares in the PVFC and sells the same at $3.50 per share with a maturity of, let's say, 2 years. So the lower strike price is then set to $4 per share, and the upper strike price is set to $6 per share. Now you might ask, hey, isn't the investor at the shorter end of the stick? The share price is at $5 per share, currently trading in the market, and they're only selling at $3.50 per share. So I think a few things here. Let's not forget of the entire effects of time value of money. Because of the maturity of 2 years, there's the discounting rate, depending on what was the agreed upon one. Now, they have also set two strike price. One is at the lower bound, which is $4, and the upper bound at $6. So at the end of 2 years, if the share price is trading below $4, the investors will simply deliver all the pledged shares. So there's no obligation to make up for the losses by additional shares or financial consideration. However, if the share is trading within the threshold set, that is, either between $4 to $6, the shares deal is calculated by dividing the principal and the prevailing shares, either $4, $5, or $6. On the other hand, if the share price is above the upper strike price, the investor will deliver the principal plus the excess of the share price above the upper strike price, which is $6. So 350 plus 200, that's 550,000 if it's cash settlement. Or 550 divided by $8, which is 68,550 shares. So this is definitely better than the pledged 100,000 shares in the first place. Now, allow me to basically walk you through my own thought process when I look at this entire financial engineering shenanigans. So using the same example, let's say that the share is trading at $5 and you pledged around 100,000 shares. So this is the agreed upon premise by the entire example. And there's two strike price. The lower bound is at $4 and the upper bound is at $6. So now, I think back to my thinking framework, there are two separate perspectives that we have to take into consideration here. One, it's the SoftBank, which is the seller, versus the financial institution, which is the buyer in this case. So I basically want to see what are the incentive structure underpinning both their actions to basically investigate whether is there any validity when we talk about all of them not wanting Alibaba share price to recover. So from SoftBank's perspective, simply put, they pledged essentially 100,000 shares and they received a total of around $350,000. So that's because of the time value of money, the maturity, and the fees involved, etc. The ideal case for SoftBank to be in between the agreed upon range, which is $4 to $6. And I'll explain why later on. Now, why is it $4 to $6 the best case scenario for SoftBank? Because number one, they have to give up lesser than pledge. In fact, the most ideal case is when the share price is at the upper bound of the range, which means it's at $6. So assuming that the x-axis is the share price and the y-axis is the number of shares that SoftBank needs to give up, at $4, that's 87,500 shares. If it's at $5, so 350,000 we divide it by 5, that's actually 70,000 shares. And last but not least, 350,000 divided by 6, it's actually at 58,333 shares. So if we just plot a very simple graph, so I'll just plot a simple, this is downward sloping. Now, we have to then look at what are the scenarios when the share price is actually above and below the upper and lower bound. So I think based on the example, you know that if the share price is below the lower bound, they basically just fork out the 100,000 shares. So here's what happens. It's basically a straight line, and then anything below $4, you pay everything. You give out the entire pledged shares. So what happens if the share price is actually above $6? So here's the interesting thing. If it's above $6, because of the very complicated calculation, simply put, depending on the number of shares that they have to fork out, assuming that the strike price is now at $8. So what they have to fork out is actually $350,000 plus $8 minus $6, which is the difference in terms of the strike price, times the 100,000 that is pledged. So this will actually work out to $550,000. And if we take 550k divided by the prevailing share price, that's around 68.7500. So you can see that the amount of shares needed actually increases back up. And simply put, as the share price increase, the number of shares needed actually goes up. So this is basically the payout diagram. Now, let's look at it from the broker perspective or the financial institution. So upon receiving the order of the contract, they have two positions that they can take. Firstly, they can keep the equity risk on their portfolio. And then secondly, they can actually short sell the position right into the market. So what do I mean by keeping the equity risk on their portfolio? So it means that when they enter into the contract, they just pay SoftBank upfront and then they keep the exposure. So presuming that everybody are logical and they wish to hedge their books, most of the time, unless the broker or for whatever reason the financial institution is extremely bullish of the position, then they'll keep the equity risk on their books. If not, what they'll do is immediately short the position in the open market so that they can receive the capital. On whether they short the entire pledge position, that's up for the entire risk management team to decide. But let's assuming that they actually do short the entire position that is pledged here. So at order date, we know that the share price is actually trading at $5 and the pledge amount is 100,000 shares. So when they sell out into the open market, they immediately receive $500,000 today. So what they will then do is actually pass this 350,000, which is a negative position, to SoftBank. Net, they actually have $150,000 on their books. And this is unrealized because let's not forget, on this $150,000 on their books, they have a negative 100,000 shares exposure. So assume that the share price is below the strike price. Is at maybe let's say $3 below the lower bound. So that's very simple because if it's at the lower bound, SoftBank just needs to pledge all 100,000. So this 100,000 will basically net off this 100,000 short exposure, and then you get to keep the $150,000 on their books initially. So at $5, SoftBank only need to hand over 70,000 shares. So what happened to the remaining 30,000 short exposure? They will have to cover it on their own. So they have to essentially buy back 30,000 shares at $5 per share, so that's 150k. And net, you can see that they actually use this 150k on their books to remove the exposure. But let's not forget, the broker still wins here. So in fact, the 150k today is actually worth more. So net, they are still in a good position. So at $6, SoftBank actually only need to hand over 58.3k shares. And they have to then buy back the remaining amount of shares, which is equivalent to around 250k. So this is when the brokers actually do make a loss. There's a lot of assumptions here. So what is their rate of return on the 150k that was afforded to them in the first place? I don't know. But I'm just going to make the very layman vanilla assumption that they're going to lose a sum of money here, depending on the rate of return, etc, etc. Now, what if we push the assumption? Let's push it up to $10 instead. They have to also buy back around 250k because of the nature of the upper bound of the contract. So you can see that actually, from the broker's perspective, their maximum loss is actually here, which is around $100,000. So here's the interesting thing. Here is actually the payout diagram when the share price actually falls between $4 to $5. So just a recap, at below $4, it's a very simple cover. The SoftBank will hand over 100,000 shares, they'll minus the 100,000 exposure, and then they get to pocket the $150,000 that they initially have on their books. When the share price actually stays at $5, the broker actually still benefits. Only after $5, then they'll start experiencing a loss, but the loss is still capped because of the nature of the contract. And last but not least, when you look at the lower bound, which is between $4 to $5, the broker actually is still in a net positive position. But of course, as it approaches the $5 range, they actually earn lesser and lesser. So this is the payout graph from the broker's perspective. So in their perspective, simply put, they want the share price to be below $5 and as low as possible. As long as it's below the lower bound, they have maximum profits. If it's at the initial price in the first place, they still benefit, and losses only come if it breaches the agreed upon price. Now, moving back to the payout diagram of the seller, you can see that they actually don't want to be at the lower bound. Anywhere in between, they are still benefiting. So this is Chikeng in post-editing. So I realized that I probably didn't do a very good conclusion. So here is up. I think just to simply tie up this entire discussion, I think one idea on why this post actually went so viral was really because there's a valid argument. I think when all things considered, when you look at it from the broker's perspective, it's true that their incentive is to keep the share price down. From the seller's perspective, which is SoftBank in this case, it's true that they are of opposite payout diagrams. For SoftBank specifically, as long as they keep it in the sweet spot, that's the best case scenario for them. They wouldn't want the share price to go rallying upwards like crazy as well. But on the same note, they also don't want the share price to just collapse on itself. So I think the crux of the issue here is where is that range? So assuming that what the author said is true, the range bound probably is between $80 to $100. And from that perspective, you can see that why Alibaba is basically trading right around that range. But recently, they've actually broken down that range to go below 80 and even breaching the $70 mark. And if that's what's happening behind the scenes, we can tell that why there's some sort of a cap and Alibaba is basically being submerged underwater. I think all things considered, let's not forget two things. Firstly, SoftBank has already expressed their explicit intent to sell off Alibaba, and being a large institutional shareholder at the peak with 30% of their shareholding, that's $100 billion worth of selling pressure on a $400 billion market cap company. That's immense selling pressure. That's why the share price basically collapsed. And then point number two, which is the more important factor, I think for traders that are more interested in the short-term price action, yes, this is very interesting news and very interesting volatility for you to trade around the shares. But on the flip side of the coin, for those of you who are investors, is this not the kind of selling pressure that you hope for? You wish to accumulate more shares if the company is able to maintain their growth, their margins, their earnings, and they are friendly to shareholders because they allocate capital back, whether is it via buybacks or dividends. It just means that they're going to give you a much lower valuations to enter. Think about it. With that, I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye.